Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 270 on May the 13th, 2023. I'm your host, Eric, and in this week's show, we'll cover the trades from last week on Fisker Inc, DraftKings, and Affirm Holdings, and we'll discuss three new trades on FuboTV Inc, the MSCI Brazil ETF, and Li Auto Inc. Now, it's always great to hear from listeners. If you have any questions about the trades presented here on the show or even about your own positions, feel free to email me. You can email questions to eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. I've also created a few videos to teach you all the basics of option trading that you'll need to know to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit the YouTube channel for the Weekly Option. And for anyone that wants to learn how to trade options, I teach students how to trade options, not just study theory, with the combination of videos and live coaching calls. If you're ready to take your trading to the next level, send me an email to schedule a phone call. Now, the markets inched slightly lower this week. The Dow Jones Industrial Average lost 373 points, closing at 33,300 points. The S&P 500 index lost 12 points, ending the week at 4,124 points. And now it's time for the topic of the week. And the topic of the week this week is risk versus returns. There typically is a direct relationship between risk and returns. That means when one goes up, the other one goes up. If I want higher returns, I need to take on more risk. Or if I want less risk, I need to expect lower returns. When I worked as a professional trader, the companies I worked for typically wanted an inverse relationship. They wanted you to make more money while reducing risk. That typically is not how the game is played. This is yet another reason why I like trading options for myself. I can create a strategy with a fixed amount of risk that can still create extraordinary returns in a short amount of time. If you were to tell your friends that I share trades on this show that can return 30 to 50% return within a month, they would think I was lying. My response is that it's just math. They can do the math just like anyone else and calculate the returns for themselves. You can follow along on the show or even put similar trades on yourself and fully experience what I'm talking about. I love the phrase, numbers don't lie. To get these sorts of returns in short time frames with stock means you typically are taking on a company with a high amount of risk. Maybe it's earnings or some news update. With options, it's normal if you know what to look for. Even with only 1 week left before expiration, there's still plenty of opportunities to make 25% return in 5 days. If you pay 80 cents for a $1 in the money spread, if it expires for $1, then you made 20 cents on 80 cents of risk. That's 25% return in 1 week. So do the math and always understand the risk you're taking on to get the return that you're seeking. Let's dive into the trading review for last week's trades. We're going to start off with the covered call on Fisker Inc, symbol F as in Foxtrot, S as in Sierra, R as in Romeo. At the time, the stock was trading for $6.22 per share. I looked at buying stock and selling the May 6.5 call at 55 cents, which could give us a return of 13.34% in 2 weeks. Well, shares of Fisker lost 13 cents, ending the week at $6.09 per share. The call option we sold lost 26 cents, leaving us with a net profit of 13 cents per share if we were to close the trade immediately. And with only 1 more week before expiration, you'll have to decide whether you want to close the trade completely by buying back the option and selling the shares of stock. Of course, if stock rises above $6.50 per share this week, the call option we sold will expire in the money and we'll deliver the shares of stock to the person that bought the call option. If you don't think stock will expire above $6.50 in the next 5 days, then the call option will expire out of the money and we'll get to keep the full premium we collected when we sold it. Next up, we would either sell out of the stock to close the trade completely or decide to hold on to the stock and look to sell another call option in the month of June. I might even consider selling an in-the-money call option in June to synthetically sell the shares of stock above the current price of the stock. I discussed this method a month or so ago. It's just a better way to sell stock. Either way, this trade should be a nice winner if I'm able to keep the full premium we collected for selling the call option and can sell another option in the month of June. We are well above our break-even point, so the only thing pushing us to make any adjustments or any decisions right now is that options expiration is this upcoming Friday on May the 19th. All right, our next trade on the week was a credit spread. We looked at a credit spread on DraftKings, symbol D as in Delta, K as in Kilo, N as in November, G as in Golf. At the time, the stock was trading for $24.58 per share. I looked at selling the May 24 put spread at 16 cents, which could give us a maximum possible loss of 34 cents in 2 weeks. Now, DraftKings stock lost $1.05, closing at $23.53 per share on Friday. The out-of-the-money put spread we sold is now in the money, and the spread is roughly 7 cents away from its full value. And if stock expires below $24 per share, we'll take the full loss of 34 cents per spread. So it's a good time to consider what's next. Right now, I'm short the May 24 half put, and I own the May 24 put. I can buy the May 24 half, 23 half put spread for 48 cents. And because I received 16 cents on the initial trade, that means in total, I will have paid 32 cents for the May 24, 23 half put spread. That spread has 47 cents of intrinsic value right now and could expire at full value on Friday. That's one example of flipping this from a credit spread into a debit spread in order to turn a losing trade into a profitable one given the market conditions. I always have to make sure I check all of my numbers and stay on top of the risk when I flip trades this way. With so little time before expiration, it's one of the paths to keep from locking in a full loss in a few days. Our final trade from last week was a debit spread on Affirm Holdings, symbol A as in Alpha, F as in Foxtrot, R as in Romeo, M as in Mike. At the time, the stock was trading for $10.71 per share. I looked at buying the May 9 half, 10 half call spread for 60 cents, which could give us a maximum gain of 40 cents, or that's a 66.67% return in 2 weeks. Well, Affirm Holdings shares made a nice $1.36 per share jump, ending the week at $12.07. The in-the-money call spread we bought is even more in the money, and that means we made money on this trade this week. If shares of stock remain above $10.50 per share this week, we'll capture the full spread value and lock in the full return that we planned from the start of the trade. No adjustments are needed at this time at all. Now, I do occasionally widen a spread out to lock in even more profit. For instance, if you bought the May 10 half, 11 half call spread for 80 cents, you'd add another 20 cents of profit to the trade. When you adjust these trades, you alter the risk of the trade. So more capital outlay means your break-even price also changes, and you could lose more money if the trade goes against you. So if you need help with fully understanding these sorts of adjustments, shoot me an email and we can walk through the example to help you better understand. So that's it for the trade review from last week. We're entering expiration week for the month of May. Expiration for all May monthly options will be on Friday, May 19th. The new trades today and for the next few weeks will use the June 16th expiration for June monthly options. With that being said, let's dive into our new trades. So we'll start off with a covered call on FuboTV Inc., symbol F as in Foxtrot, U as in Uniform, B as in Bravo, O as in Oscar. The stock ended the week at $1.73 per share. I'm looking at buying stock and selling the June 2 call at 15 cents, which could give us a return of 24.28% in 5 weeks. Now you enter this trade by buying stock for $1.73 and selling the June 2 call at 15 cents. This trade makes the most money if stock prices finish above $2 per share. The break-even price on this trade is $1.58 per share, and in real terms, the stock purchase would require $173, and you'll collect $15 for selling the option. Next up, we have a credit spread on the MSCI Brazil ETF, symbol E as in Echo, W as in Whiskey, Z as in Zulu. The stock ended the week at $29.78 per share. I'm looking at selling the June 29-28 put spread at 34 cents, which could give us a maximum possible loss of 66 cents per spread. Now you enter this trade by selling the June 29 put at 97 cents and concurrently buying the June 28 put for 63 cents. This is a credit spread because we're selling the spread, and this trade makes the most money if stock prices expire above $29 per share. The break-even price on this trade is $28.66. In real terms, you will collect $34 per spread that you sell and have $66 at risk. And our final trade on the week is a debit spread on Li Auto Inc., symbol L as in Lima, I as in India. The stock ended the week at $29.44 per share. I'm looking at buying the June 28-29 call spread for 63 cents. That could give us a maximum gain of 37 cents, or that would be a 58.73% return in 5 weeks. Now you enter this trade by buying the June 28 call for $2.65 and concurrently selling the June 29 call at $2.02. This is a debit spread because we're buying the spread, and this trade makes the most money if stock prices expire above $29 per share. The break-even price on this trade is $28.63 per share, and in real terms, you'll pay $63 to enter the spread, and your maximum gain is $37 per spread. So that's it for this week's show. Thank you guys so much for listening. Thank you for following along with me. Feel free to shoot me an email if you have any questions. That's eric@theweeklyoption.com. I hope you have a great weekend, and as always, happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer: there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.